All right, everyone, let me know that you can hear me and that you can see me. Feels good to be back in front of the camera. It's been about 3 weeks since I took my break from YouTube. I'm going to give you guys a lot of updates as far as that goes, what I've been working on. But really the purpose of this live stream is to go through the November 2022 newsletter and to also take your requests on data for housing markets and rental markets that you want me to evaluate for you. So get those requests and those questions ready. We're going to get started in just a couple seconds here. All right, so it's good. Okay, you guys can hear me. I'm actually in upstate New York right now. This is like a temporary studio, temporary video setup. So I was a little nervous about especially the Wi-Fi speed. So good thing that you guys can hear me and see you, or see me. So let's just get going, everyone. I'm going to start with the Reventure 2022 newsletter here, which you can see on the screen in front of you. There's a link to this newsletter in the description to the video. We're talking about the rental market crash in America. And I'm going to go through this newsletter and I'm going to be taking your requests as this video goes along, but give me about 5 minutes to go through the newsletter first. And the first thing we really need to talk about is that rents are now declining across the U.S. housing market. This is the big story over the last couple months. And declining rents, well, that's going to mean declining home prices. It's also going to mean big problems for real estate investors, especially in certain cities. And you can see here data from RealPage. We're looking at, and this data from RealPage, the decline in rents in October in America, which is the blue line. And you can see it was the third biggest decline in rents in RealPage's data going back over 10 years. So rents are falling fast. According to this data, it was a 0.6% monthly decline in October. That might not sound like a lot, but if you annualize that over the course of a year, it's over 7%. And really, the reason that rents are declining in this double-barreled housing crash I've been talking about, where prices and rents are declining, is because we're in a housing recession, as I say here in the newsletter, in America, where there's something going on called household consolidation. And in this household consolidation, the situation is occurring where people are moving in with each other. The rents have gone up a lot over the last 2 years. Inflation's been bad over the last 2 years. People can't afford it, right? So someone who's living in a one-bedroom apartment, maybe they now have a roommate. Maybe they got a roommate. Maybe they moved back in with their parents. Maybe a couple that had broken up and gotten divorced, well, maybe they found new relationships and moved in with their new significant other. Whatever it is, we're seeing fewer and fewer people demanding new rental units, and we're seeing, as a result, the vacancy rates go up across the U.S. rental market, which, as I said in the beginning, big problem for real estate investors, because the returns and the cash flows that real estate investors were getting already, well, they were super low. They were super low, and investors bought at these low cash flows and these low cap rates because they thought, oh, well, the rent is just going to keep growing forever. Well, now that the rent is going down, it's going to cause a lot of investors to have to sell out of their properties and increase the inventory on both the for sale and the rental market into the future. And what cities might that happen? Well, let's take a look at the cities that have the biggest decline in rents over the last 2 months, which you can see on this table in the newsletter. And this is data from Apartment List. We're looking at the percentage decline in rents over just the last 2 months. And we can see here, interestingly, Portland, Maine is number one, a 6.2% decline in Portland, Maine. Toledo, Ohio is number 2. And then we have our favorite crash housing market, Boise, Idaho, number 3. So Boise is one of these double-barreled housing crash markets where the prices are going down. They're negative year over year in Boise on prices. Well, now the rents are going down, and this is a big problem for the Boise housing market. Interestingly, in the markets with the biggest rent declines the last 2 months, you can see it's actually a lot of Midwest and Northeast markets. Markets where actually the for sale inventory is still low, home prices are still going up, but rents are now starting to go down in Worcester, in Providence, in Grand Rapids, in Pittsburgh, in markets like Rochester as well. So interestingly, Midwest, Northeast rental markets slowing, as it is also in California. We got a lot of California on here. Santa Rosa, Stockton, San Jose, Riverside. I know I got a lot of you guys out there in California, so let me know if you're seeing some of these declining rents. And what's interesting is 89 of the top 100 largest rental markets 89 of the top 100 largest rental markets saw a decline. So this rental crash is more evenly distributed across the U.S. housing market than the price crash and the for sale crash. Because right now the for sale crash is really in certain cities, right? We know it's in the Sun Belt, we know it's on the West Coast, but the rental crash seems to be happening all over America. So that's like a key difference to understand. And you might ask yourself the question, why is this rental crash occurring? Well, what fundamentally is causing it? Because the conventional wisdom said that the demand for rentals and the rent should keep going up, but it's not happening. And I'm going to show you here why the rental market's declining with one key data point that you should all be tracking for your housing market. And that is the vacancy rate in your housing market. And this is something that I cover here in the newsletter, and I'm actually going to show you guys an interactive graph in a second. But let's just start with Phoenix. We're going to start with Phoenix so you guys can understand what's going on with this kind of increase in vacant units that's occurring on the rental market. Take a look at the orange line here. This is the vacancy rate in the Phoenix housing market, in the rental market. You can see what happened is right when the pandemic hit, or maybe 9 months after, vacancy in Phoenix plummeted. It went from 5.3% apartment vacancy to 3.2% apartment vacancy. That was the biggest, lowest level of vacancy ever in Phoenix's apartment market. And then, so you ask yourself, what happened? Well, the vacancy rate declined, and that's what then caused the blue line, the rent, to go all the way up. So you can see it's almost a mirror image of each other. Vacancy plummets, rent surges by 27% in a year. Now, what's interesting is what's happened the last 6 months in Phoenix. We can see the vacancy rate has now surged. The vacancy rate is almost back. It's actually back above what it used to be. It's 6.2% now, the highest level in apartment list data set. And you can see what's happening now is the rent is starting to go down because the vacancy rate has surged back up. And this is really the key thing to pay attention to. And I'm going to show you guys some data now for your housing market on vacancy rate and rents. So let's get some requests going. Let's see. David has a comment. He says he spoke to some people in LA, new inventory on the ground. Oh, he's talking about cars. Okay. You guys are talking about the auto industry. Well, there's new inventory also in rentals in a market like LA. You can see the vacancy rate in Los Angeles and Orange County rentals is starting to inch back up. So the vacancy rate dropped down to 3.5% in late 2021. You can see the rents went up. Now the vacancy rate is starting to move back up. And I would really implore all of you to understand this data point for your housing market, the rental vacancy rate, because it's going to have a key impact on what happens with investors and with home prices into the future. But we can see here in LA, the vacancy rate is still pretty far below what it was before the pandemic. So we have some work to do in Los Angeles to get more vacant apartment units that are going to cause rents to go down. Let's see, what other markets do you want to see this data on vacancy rate and rents, folks? I see a request here for Sacramento. Let's not let, as much as I love all the California requests, let's not let the California people dominate this, everyone. Get requests in for your city. So we could see here Sacramento. What do we see in Sacramento? Same trend we kind of saw in Phoenix, right? The vacancy rate plummeted down to 2%. Well, now the vacancy rate surged back up to 4.4%, which is now kind of like in the long run range. The vacancy rate's in the long run range, and we can see the rent growth has flatlined. And it's basically flatlined has started to go down a little bit. Now it's going to be interesting to see what happens in Sacramento and some of these markets, everyone, is what do you think is going to happen when the rental vacancy rate keeps going up? Because as I'm going to show you in a second, we're going to see way more vacant units. We're going to see way more inventory coming in 2023. I'm going to show you data on that in a second. As this vacancy rate continues to go up, the rent's going to continue to go down. We got a request now for Raleigh. Let's move on over to North Carolina. Raleigh is an interesting market. It's one that was always affordable. The rents were around $1,200 a month before the pandemic, as you can see here. And that's because the vacancy rates were pretty high. They were around 7.5%. But then Raleigh had this big reduction in vacancy rate through late 2021 down to 3.7. Now we're up to 5.6. Same trend. Rents have flatlined, have started to go down, but we still have some work to do in Raleigh. We still need more multifamily units completed. We need to see more rental inventory before the rents really start to come down. All right, what about a market like Austin? Austin's a great market to look at, everyone. because it's one that's going to have a deluge of rental inventory coming that few people are prepared for. So take a look at this in Austin, everyone. We can see the big increase in rents, right? The average rent in Austin was around $1,300 a month for an apartment in December 2020. Now it's $1,687. So that's around a 25% increase. Well, why did that happen? It's because the vacancy rate went down from 8.2% down to 4.2%. Like in almost every other market, the vacancy rate plummeted, but now the vacancy rate is shooting back up, and it's shooting back up fast to 6.8%, which is a smidge below what it used to be, but we're almost there in Austin on the rental vacancy rate that's going to cause this rental rate to start going down by even more. Now, I'm going to get into more of your requests later in this video for some other data points, but let's get one more on the rental market. If I don't get to your city, it's okay. I'm going to do more requests later. Let's take a look at Las Vegas, everyone. This is one I kind of want to show you guys as a great example of a housing market where the rental market's like in a crash stage in Vegas. Because you can see this vacancy rate here of 6.2%. It's more than double what it was a year ago. So look at this vacancy rate increase, folks. Boom! In Vegas, rents flatline, now they're going down, and they're going to start to go way down in a market like Las Vegas. So the thing to look for is when the vacancy rate gets above what it was before the pandemic, that's when rents are going to start to head south. And I'm going to get to more of your requests in a second, but I want to get back to the newsletter here because there's some really important things we need to talk about in the newsletter. And that is, probably the biggest thing is the apartment construction, right? I know a lot of you guys are probably looking at those rents and you're saying, okay, they've started going down, but they're still high. Like, when are we going to see the rents and the home prices really start to drop? And a lot of it has to do with the inventory, right? And the new construction inventory. And particularly for apartments here, everyone, we have a record number of apartments actively under construction. Take a look at this. Like, I don't think people really fully understand just how much inventory is here and is being built. We have 900,000 apartment units currently under construction in America. You could see that that's more than double what it was in 06-07 at the peak of the previous bubble. And you can see this is the highest level since 1973. So there's like just a historic amount of supply in the pipeline. And really, what concerns me for the apartment market and for real estate investors is that it's not just the amount under construction, it's the amount under construction above what's completed, which is the orange line. So we have 352,000 apartment units completed over the last year, but 900,000 under construction. That's telling you there's a massive 550,000 backlog that is about to be delivered, is about to hit the U.S. rental market. It's going to cause those vacancy rates to surge, and it's going to cause those rental rates to go down by even more, which is going to cause home prices to go down by even more. And in particular, certain cities have a big backlog of apartment construction. And what you can see on this graph, like if you're in one of these cities on this table, I would be expecting declining rents, not just for the fall of 2022, but throughout 2023. Because it's these cities that have the biggest surge in backlog of multifamily permitting and construction. And the way that I figured this table out was I simply looked at the permits for multifamily pulled over the previous 2 years, and I divided it by the permits pulled over the 10 years before that. So in San Antonio, for instance, 18,000 permits the last 2 years, 28,000 over the previous 10 years. So 63% of the permitting in the last 12 years in San Antonio has happened in just the last 2 years, which is insane. That is wild, and that is suggesting a massive backlog of apartments in San Antonio, in Jacksonville, in Boise, in Philadelphia, in Provo, Utah. I saw someone requesting Provo earlier. Richmond, Virginia, Detroit, Reno, Minneapolis, Phoenix. You guys can get into the rest of this list if you look at the newsletter, but these housing markets are just going to have a wallop of rental inventory delivered in 2023 that's going to cause investors to just have big problems, everyone, because let me show you here. So, the issue for investors, and let me just talk to you straight up before I show you that table. Investors were already buying at very low cap rates. in the US housing market this year. A 3% cap rate, a 4% cap rate, a 5% cap rate. They were accepting very low returns because interest rates were low. But now interest rates are high or higher. And these higher interest rates meaning that a lot of these investors are losing money on their investment properties after they pay their lender. Now, a lot of these investors are going to key you in on how they're thinking. They said to themselves, especially the big ones, they said, okay, that sucks, but they said, it's okay because we're going to keep growing the rent. They thought they could just keep growing the rent. They convinced themselves of all these narratives about inflation and housing shortage, and they thought the rent was just going to go up forever. Because if the rent went up forever, then they could eventually grow their cap rate and they would make money. But now, there's a big problem. The rents are going down. So the rents are going down at a time when the cap rates are already very low. So there's really like no wiggle room for cap rates to go lower, which is what declining rent is going to do. And so where I'm getting with this, everyone, is that these declining rents, as I've said many times on my channel, they're going to cause a big fire sale in the housing markets among investors. And this fire sale has already started. It has already started. Like in a market like Phoenix, it's going nuts. In other cities, it started, but a lot of investors who are fire selling are just selling to other investors in certain cities. Like for every investor that's selling, there's another investor buying, and it's not really adding net inventory. But at a certain point, as the rents go down by more, and as the prices go down by more, and as the lenders to these investors get really pissed off, they're going to force these investors to liquidate, and we're going to reach a tipping point sometime in early 2023 where a lot of these investors are just forced to sell. And the markets that they're going to be forced to sell in primarily are going to be, I think, the ones with the lowest cap rates, right? So on this table here on the newsletter, we're looking at cap rates, the cities with the lowest cap rates, which I'm calling the worst cities for investors. Because if you have a cap rate, everyone, of like in Austin, the cap rate's 2%. You're getting a 2% return if you buy in Austin when mortgage rates are 6%. It makes no sense. In LA, the cap rate's 3%. In San Antonio, it's 3%. In San Diego, it's 3%. In Reno, it's 3.2%. So, like, investors in these markets are already losing money. Anyone who bought really in the last year is probably losing money. And they will lose even more money with declining rents, which will cause a big liquidation and cause home prices to go down by even more in these lower cap rate markets especially. Now, I think a lot of you are probably wondering, you're following me with this narrative in your thesis, but I think you're maybe wondering, like, okay, like, when's this going to happen? And, like, how bad is it going to be? Like, how much are rents going to actually go down? And how much is that going to cause home prices to go down? And no one can say for sure exactly, right? Not Nostradamus here, but I have some predictions now that I'm going to reveal to you, and I revealed them to you in the last page of the newsletter, and let's just go through some of these predictions. And then I'm going to get into your requests after this. So, first prediction. Rents, I think, are going to decline by double digits, which means more than 10% in hot Sunbelt markets like Austin, Phoenix, Vegas. I think Charlotte's a candidate for that. I think Atlanta's a candidate for that. Tampa's a candidate for that. Basically, these hot Sunbelt markets where the rents went way up and then the home building and the apartment building's insane, I think we're going to see double-digit rental rate declines, which is going to cause huge issues in those housing markets. Now, interestingly, I also think we're going to see rents decline in some affordable Midwest metros. A lot of you know I've been more bullish on the Midwest, but it's actually, I was kind of surprised, a lot of the Midwest metros have permitted a lot of apartments the last 2 years, like Minneapolis, Detroit, and St. Louis. So don't be surprised if we also see rents continue to go down in parts of the Midwest. Maybe not by 10%, but I think we could see rents go down there more than I initially expected. Now, I also think that the markets that will perform best in this rental crash will be expensive coastal areas like New York, Boston, and LA. So these markets are really expensive, but I think right now there's a trend of younger people moving back to the city. Like, that's something I'm feeling myself with what I'm doing. My friends, that's what people are doing. And I think, especially as the recession gets worse, people lose their jobs, they're going to want to move to areas that are close to jobs. So I think the big cities, the expensive cities, are actually going to do the best. While they've done the worst the last 2 to 3 years, I think they're going to perform the best over the next 2 to 3 years in terms of the rental market. Now, speaking of a recession, everyone, what's crazy about this rental market decline and the home price decline is that it's occurring alongside a 3.7% unemployment rate, which is near a record low. So, like, the labor market is still near the strongest it's ever been, but we're already seeing huge problems in the for sale and rental market. So as the recession gets worse and job losses mount, this is going to cause vacancy rates to go up by even more, meaning that there's another shoe to drop, so to speak, on apartment demand and rental demand in 2023. Now, the million-dollar question: how much is this going to cause home prices to go down? And I think this is something that's what I call asymmetric. It's not linear. Here's why. Like in a market like Atlanta, if rents decline by 10%, there's a chance that could completely blow out investors in Atlanta. Like, we know that a huge corporate investor presence there, 30% of the homes are purchased by investors. If rents go down by 10%, there is a chance there's a fire sale in Atlanta that's unprecedented and values go down by 40% in certain neighborhoods, right? Like, that's certainly a possibility. And it would be a decline in prices that would be more than I would expect based on the underlying data. But that's something that could happen given the risk and the concentration of investor activity in certain cities, right? So it's going to be investor-driven cities also that have the biggest exposure to this rental crash. Now, it might not happen that way in such like a violent fashion. It could be more incremental. Declining rents just slowly turn investors off to certain markets, and we see prices go down incrementally as well. But the bottom line is, everyone, declining rents means declining home prices into the future. It also has really interesting implications on inflation. Declining rents means that inflation is going to decline into the future, and really suggests, I think, that the Federal Reserve and Jerome Powell are like over-tightening right now. Like, I know we needed to tighten to combat inflation, but like when you see the rental market turning down and when you see apartment demand at its lowest level in 3 decades, that's telling you that we're going to have disinflation or deflationary pressures just as the Fed is aggressively hiking and taking money out of the system. So this is something that could blow up big time in 2023 and cause a deflationary crash. Now, with all of that, everyone, I'm going to get to your requests and questions. And for your requests, I'm going to look at the Metro Data dashboard. We're going to look at particularly inventory and price cuts. So we're going to switch to looking at the for sale market for these next requests. But let me just take a look at what you guys are saying so far here in the comment section. So let's see. Vivian says that Atlanta needs to go down by 40%. That is true. Let's see. Hendrick says, how's San Francisco market doing going forward? Let's see. Okay, let's take a look at San Francisco, and we're going to look at the for sale market now. You guys have access to this tool here. This is the Metro Data dashboard. This is one of the benefits you have as a channel member. Let's take a look at what's going on in San Francisco's housing market here. And I'm going to take more of your requests here in a second. But so we can see inventory in San Francisco on the for sale market is up to over 6,000 homes, which is near the highest level in 5 years. So we clearly have a lot of inventory on the market in San Francisco. You could see the inventory is a bit volatile depending on the season. But what's really intriguing me is price cuts. So now 29% of the listings in San Francisco have a price cut. And that is very high for San Francisco. You can see normally it's like 10 to 15%. So this is a market that's in a crash, and especially due to all the issues going on in tech, I think both prices and rents in San Francisco are going to go down more into the future. Let's see here. So how about another request for Columbus, Ohio, everyone? I lived in Columbus for about 9 months. It's a nice city. And you can see the price cuts in Columbus are starting to surge. 37% of the listings in Columbus now have a price cut, according to Realtor.com. That's the highest level in Columbus in Realtor.com's data set. And you can see here, especially we have some high price cuts in some of these zip codes directly to the south of the downtown. I think some of these would be like German Village maybe. We have some high price cuts kind of in some of these areas with higher poverty rates that had a lot of investor activity in Columbus. Let's see, what other markets do you guys want me to cover? We have a question here actually from Surendra about Austin. What do you think about Austin in the next 6 months? Buy now or wait? Well, Austin is a definite wait because as you can see here, 65% of the listings in Austin now have a price cut. That is almost double what the previous high is. I mean, take a look at this graph, everyone. I mean, it's insane. Additionally, inventory on the Austin housing market is now almost at its highest level in 5 years as well. And so you got to ask yourself, okay, what's going to happen in Austin over the next 6 months? Well, we have a tech recession in America where companies like Facebook are laying off 10,000 people. Facebook also just is now subleasing their entire office building that they built in Austin. The economic fundamentals in a market like Austin or any tech-driven market are very bad right now and into the future. So I think Austin is going to get better for you as a buyer 6 months from now. There's also lots of home building. All right, what about Denver? Denver's another tech-driven market that I think is really an interesting one to check out. So in Denver, interestingly, the inventory, 6,600 homes on the market. We're still actually kind of, we're up on inventory, but we're not quite where we were before the pandemic in Denver. In terms of price cuts, though, we have lots and lots of price cuts. 48% of the listings in Denver have a price cut. And so this is like Austin, a very tech-driven market, lots of price cuts, inventory's going up. I think it's going to continue to get better for you as a buyer in Denver over the next 6 months. All right, what about KM? KM has an interesting comment here. Despite price cuts, Boise is still very overpriced compared to median income. What do you think is keeping the prices still so overvalued? All right, so this is a good question. Let's actually switch to looking at the PE ratio crash predictor here, everyone. If you guys haven't checked out this tool, you should definitely check it out. It's part of your benefits as a channel member. And, the issue here in Boise, like KM said, is that even though the prices are going down in Boise, they're still way higher than the local wages. So, the typical price in Boise is now 10 times higher than the local wage, which is suggesting that there could be another 37% decline in Boise to come. So, this is a market that I think is going to continue to crash in Boise, Idaho. There was a question, well, what's keeping values from crashing faster? And I think that's just something where home prices don't go down as fast as maybe you would want. It's not quite like the stock market. In the stock market, the value of a stock could go down by 50% in a week. It's going to take time for home prices to go down, mainly because sellers need to get out of their own way. A lot of sellers have this emotional attachment to their house, and they see their neighbor sold their house for X a year ago, and they think they should sell their house for that amount, and it's going to take some them getting over cognitive dissonance to get there, but they'll get there in a market like Boise, and you can see they're already getting there. All right, how about a market like Naples? This is a good one. I know a lot of you are in Southwest Florida. Let's see what's going on in Naples. So Naples is an interesting one. You can see here, this is still a big, big bubble, right, according to PE ratio. The typical home price in Naples is 12 times how much the average worker earns. And I think we all know the average worker in Naples is not really the one buying the homes. It's people coming in with cash, buying second homes, buying a retirement home. But you could see the values here are just still so overvalued, right? And they're going to have to come down in Naples over the next several years, especially as second home buying declines due to higher interest rates in the recession. All right, everyone. This is an interesting comment from Nolan. He says that realtors are not helping sellers get there. That's an interesting point. I'm seeing that here in upstate New York. I was looking at some listings in a town called Hudson, pretty close to where I grew up, and yeah, it's crazy how overvalued some of the listings still are in certain cities. And yeah, they're getting bad advice from their realtors, but the thing is, at the end of the day, everyone, this is just math. How much money do people make? Do they make enough to afford the down payments and the mortgage payments? Yes or no? Eventually, the housing market's going to get to that place where it needs to go. All right, what about another request? How about Riverside, California, everyone? Riverside's a really interesting market. It's one that had a huge crash. Riverside had a huge crash last time around. From 2007 to 2012, prices in Riverside went down by about 50%. All right, so now, we're back almost in the same place in Riverside in terms of how overvalued the housing market is. My PE crash model says maybe a 33% decline in prices could be coming. in Riverside, and that's something that's already started. I mean, if we look at the number of price cuts in Riverside, 33% of the listings have a price cut, and if we look at inventory, we can see the inventory is really starting to get back closer to those pre-pandemic levels. All right, what about another market here? I know a lot of you are requesting actually, a lot of you are requesting Raleigh. I'm seeing that in a lot of requests. Let's take a look at Raleigh, and I'm going to take a couple of your questions before signing off here. So Raleigh's a market where the inventory has surged. I mean, look at this, everyone. We went from 700 homes on the market in Raleigh in March to 4,000 in October. And the way to think about prices is, right, like the median list price in Raleigh, right, like you can see the median list price is going down, but like there's a lag. You know, the median list price peaked in June, right, even as inventory was going up. So there's a lag. Like the prices today are reflective of what the inventory was a year ago or 6 months ago. So these higher inventory levels are just now starting to be felt in terms of price cuts, especially. You can see in Raleigh we have a near record amount of price cuts, and this is a market that also has a lot of home building and apartment building, and where I think prices and rents are going to continue to go down. What about New York City, everyone? New York. All right, what's going on in New York? New York is a market that is not in a crash stage yet. You know, it's really interesting. Only 15% of listings in the New York metro have a price cut. If we zoom in here on this map, you know, you could see that it's pretty uniformly distributed. Price cuts in Manhattan are actually, in Brooklyn, are actually pretty low right now. Inventory, where's inventory? 40,000 homes on the market in New York. That's pretty well below what it was before the pandemic. So New York situation is reflecting, you know, something I've talked a lot about before, how at least the for sale market in the Northeast seems to be slow to crash. You know, it's still pretty tight. We're not seeing values come down by much yet in the Northeast, but I think we'll get there, especially because the rental market is starting to decline in a city like New York. Maybe the rental crash won't be huge in New York, but declining rents are going to mean eventually declining prices. All right. Alan CPA says, Twitter, is anyone still working there? That's a great question. I think they're down to like 2,000 employees. By the way, for those of you that don't know, I do have a Twitter. If you guys want to follow me on Twitter, I've been more active on there, at NickJurley1 on Twitter. If you guys want to follow me, I've been trying to get my followers on there up over the last couple months. I'm up to 25,000 now on Twitter. Help me get that number up. All right, what about Bakersfield? We got 2 requests for Bakersfield, back to back. All right, so let's look at Bakersfield. You know, this is a market that was a huge crash market. In the last crash, I think it's going to have more of a correction this time. We can see the inventory in Bakersfield is up to 1,800 homes on the market. Still below what it was before the pandemic, but it's gone up enough to cause the price cuts to go way up. So we are up to 35% of the listings in Bakersfield with a price cut. And I think, you know, values are going to keep going down because they're fundamentally overvalued. If we go to the PE crash predictor, 6.4 PE ratio in Bakersfield, we're around 4.5 long term, suggesting 30% downside in prices. And what I encourage a lot of you to do, you know, as a channel member, I know you guys like seeing me talk about this data, but you have access to these tools, right? Metro Data Dashboard Crash Predictor. You can really answer a lot of questions here by going to these tools and looking at how fundamentally overvalued your housing market is and comparing it to what the real-time data on price cuts in the inventory says. All right, let's see. Mean Hall is requesting Charleston. She's been looking for a few years, but still super low inventory. Yeah, let's check out Charleston, everyone, and see what's going on in that housing market. Well, interestingly, price cuts in Charleston are up. 36% of the listings in Charleston now have a price cut. And the inventory, well, yeah, the inventory is still really low at 2,400 units. But this is kind of interesting, everyone. It shows you how you don't need the for sale inventory to get back to the pre-pandemic levels before people start cutting the price. And obviously prices are still high in Charleston, but we could see positive movement in terms of price cuts, even with inventory that is still 50% almost below what it was before the pandemic. Let's see here. Eric says he doesn't remember how to access the data in the dashboard. I will post links to the member community board over the next couple of days so you guys have access. Let's see, what other requests do we have? How about Cleveland, Ohio, everyone? I have time for maybe 2 more requests after this before I got to sign off. And then I'm also going to give you an update about when I'm going to return to YouTube and what I'm doing with the Reventure app. All right, Cleveland, Ohio. 3,500 homes on the market for sale. That's still 50% below pre-pandemic levels, so we have a ways to go as far as inventory in Cleveland, but the price cuts are now increasing, and I think the prices overall are starting to go down in Cleveland, although it's still a pretty tight market. Rents are also starting to go down in Cleveland, so I wouldn't expect a crash in Cleveland. Like the PE ratio crash predictor is predicting a 17% decline in prices, or a 17% improvement in affordability. So, that would be more of a correction, I think, than a crash, but certainly I think prices are going to get cheaper in Cleveland over the next couple of years. Ooh, this is actually a great question, everyone. A great question from Seamus. He says, shouldn't prices crash below the PE average for a market because reversion to the mean usually goes below the mean? So, yeah, that's an interesting point. Let me show you guys what Seamus is talking about. So if we go to Phoenix, we could see like in the last crash, the PE ratio went way below the yellow line, right? So it went below the mean because basically it was foreclosures and so much inventory that it just became, the opposite happened from a housing bubble to like a devastating housing crash. So theoretically, yeah, I mean, the same thing could happen this time in Phoenix where the PE ratio goes below 5.4. And the crash could even be even bigger. That's not something that I feel comfortable projecting, but it's something that could happen. So these projections are all kind of assuming like a return to normal in terms of affordability. But yes, certainly the affordability could get even better than normal if the crash is bad enough. Let's see, Brain Hack Coder asks, is there a way to download the data from your Tableau graphs? No. But I guess that's a good segue for me to give you guys an update on the Reventure app. So about 1,000 of you guys are on the beta testing list for the Reventure app. So I think some of you have been using it already. I'll actually pull it up here on the screen in front of me in a second. But my goal is with the Reventure app that you guys will have access to all this data all the time, right? So any question you have on the housing market, any graph you want, it is going to be available in the Reventure app. And you could see the Reventure app here on the screen in front of you, basically an entire map of the U.S. housing market. You could look at every geographic level, every data point, and what I'm really excited about is the filtering. Like you guys can say, all right, I want to look for affordable housing markets. Okay, these are the affordable housing markets in America. And then you could say, all right, I want markets where inventory is growing. All right, affordable plus growing inventory. Now this is like a list that you have to work from to understand maybe a new city to buy or if your city is a good one to buy. Alternatively, what I'm also really excited about with the Reventure app is what you can do in your local housing market. So if we look and zoom in a place like Austin and look at different zip codes, you could apply the same level of filtering and understanding about what's going on to your local neighborhood and say, okay, like what are the zip codes in Austin with the biggest increase in inventory? Well, there you go. You could see them right there. And this is something that is still in the beta testing phase. If you guys haven't tested it out and you want to, you can go to beta.reventure.app and sign up for it. But my vision for this, is basically a culmination of everything I've done on my YouTube channel, all the data I put together. It needs to be a website that everyone has access to and can look at all the data. And this is going to be released in the next 2 months officially. And when it's released, there's going to be a free version with basic data, and then there's going to be a paid version for real estate investors and realtors who want access to all the data. And so that's one of the things I've been working on over the last 2 weeks during my break is the Reventure app and making sure it's as good as it can be going forward and when I release it at the end of the year. And so like I said, if you guys want to test it, go to beta.reventure.app and you should be able to sign up and test it. All right, everyone. What else? Oh yeah, how about an update actually on when I'm going to return to YouTube? Some of you saw the article I wrote on the Reventure app website where I told you guys about this, but right now there's no immediate plans to return to YouTube. I'm enjoying my time off here and I didn't really realize kind of maybe how burnt out I was from creating YouTube videos over the last 2 years. So I'm still going to be off YouTube for at least another month or two. However, I will still be checking in with you guys on these members-only live streams probably once every 2 weeks. So if you enjoyed this live stream, expect another one in 2 weeks, and I'll also be giving you guys, data on the community posts and the interactive graphs and maps. So let's see. I guess that about does it for today, everyone. Let's see. Last couple questions, I guess. Okay. Actually, let me get this request because Mike, I think, asked it a couple times. Let's look at Houston. Let's look at Houston, Texas, and see what's going on in that housing market. All right, everyone. Houston, Texas's housing market. 31% price cuts. So this is up, but this is not as high as it used to be. Inventory. 21,000 homes on the market for sale, way less than it was. So Houston's a market that, and you can actually see here, the inventory in certain zip codes is down year over year still. So inventory is growing a lot in the north, is still declining in the urban areas. But Houston's a market that I don't think is going to be a major crash market. I think it's going to be more of a correction market on the order of 15%. We're starting to see prices turn down, but Houston's not at the same level of, say, an Austin or a Phoenix in terms of how much it's crashing. All right, everyone. That's it for today. Thank you all for joining. And like I said, 2 weeks from now, I'll be doing another live stream, so keep your eyes peeled for that. Until then, see ya.